Retirement is something that we look forward to, the time that we can keep back to realize. We all know the goals of retirement savings, to have enough money to cover our expenses and having little left over for the fun stuff. We're tricky of knowing the best way to pursue those goals, and one of them are the type of investment which divide into two categories, which is the first is the physical investment and the second one is the financial asset. The physical investment comprising the real property and other form of tangible asset. For example, it will be a home. The second category of investment is the financial asset in the form of securities and bank deposits.
Constant dollar cost averaging concept is an investment strategy in which an investor divides up the total amount to be invested across periodic purchases of a target asset to reduce the impact of volatility on the overall purchases. This concept is a tool for an investor for them to use to build saving and wealth over a long period. By using this strategy, it allows the average client to invest without having no worry about when is the right time for them to invest. The main advantage is that it allows the client to gain in the long term without the need to be a brilliant or lucky investor. It just needs him to be more disciplined. There are three examples of the situation market that I'm going to show you. First, we will look at the erratic market example by constant dollar cost averaging, where we have 5 investment period and we invest the regular amount that is 700 per period. When the situation is irritable, we can see that the unit price is fluctuating, and we also can see that the unit acquired is varied according to the price per unit. So, let's see, at the first investment period, the amount that we invest is 700 and the unit price at this time is 50 ringgit, where we can only get 14 units to buy. During the irritable market, we can see that the total of unit price is 220 ringgit and the total of units acquired is 82 units. Now, we have to calculate the average unit price, where we will get 44 ringgit, while the average unit cost is 42 ringgit and 68 cents. Nevertheless, as we can see that during the falling market, if we consistent our investment period, which is 5 years and amount invested 700, we can see that in the falling market, the price unit seems to be reduced from 50 ringgit at the first year to 10 ringgit at the 5th year. But as we can see here, if the unit price is lower, the unit acquired will be higher, which means we can buy more units. Now, if we look at the average unit price, which is 35 ringgit and 80 cents, which is lower compared to erratic market just now, and the average of cost is also lower. This means during this time we can buy at the low price, but during at the good time where price is higher, we can sell it at higher price. Or when in a good market where the profit from the investment is higher, we can make more profit. During rising market, the unit price is higher while the units acquired is getting lower. We can see that the average unit price is 28 ringgit and 80 cents and the average unit cost is 23 ringgit and 81 cents. During the rising market, the rate of return normally higher, but the units acquired is lower.
In year 1, the beginning net asset value of Fund A is 1 ringgit 50 cent and ending net asset value is 2 ringgit. From that, we can see the changes of 1 ringgit 50 cent and 2 ringgit is increased by 33.33% and it is positive. But how to calculate the percent changes? Let's see the table below that provide the formula of percent changes. The formula is ending net asset value minus with beginning net asset value and then divided by beginning net asset value. and you can get the answer is 33.33%. Next, the beginning net asset value of year 2 is based on ending net asset value year 1, and the ending net asset value is RM1.50. The percent change negative because net asset value is decreased from RM2 to RM1.50. At the end of year 3, it increased to RM2, but unfortunately dropped back to RM1.50 at the end of year 4. And you can see the percent changes in the table. Over the last 4 years, there is zero gain because the beginning net asset value in year 1 same with ending net asset value of year 4. Fund B also started with net asset value of RM1.50 but dropped to RM1 at the end of year 1 and make the percent changes is negative. It recovered to RM1.50 at the end of year 2. So, the percent change be positive 50%. Nonetheless, it suffered another decline to drop to RM1 at the end of year 3 before climbing back to RM1.50 at the end of year 4. This fund also registered as zero gain after 4 years. By observation, we can see that none of these funds managed to make any gain for investment after 4 years. Nevertheless, in Fund A, had ability to grow above from its original NAV by 33.33% to RM2. Its NAV never dropped below its original NAV. While Fund B never made any progress above its original NAV of RM1.50. The performance for past 4 years was really disappointing. In conclude, Fund A is more favorable compared to Fund B. Based on the formula arithmetic rate of return for Fund A, average annual return is 4.17% is actually bad compared with the Fund B that get annual rate of return is 8.34%. The least one can say is that the annual return of 8.34% was significantly higher than the rate of inflation and dividend offered by EPF in 2019. As we can see that Fund B is better compared with Fund A by using arithmetic rate of return because Fund B can get more return.
Another analysis that you can perform to analyze which fund is actually better for our investment is what we call as geometric mean of return. There are several situations in geometric mean where the first situation is we are gonna calculate the result under one lump sum investment or single contribution investment, while in the second situation is where we are going to use dollar cost averaging. In dollar cost averaging, there will be a constant payment for each of the periods. In order to understand what is one lump sum investment and what is dollar cost averaging is, let's take a look at the example. So in this example, we are focusing on one lump sum investment or single contribution investment. So if we assume that an investment has 60,000 that is invested in one lump sum 4 years ago, the value after 4 years shall be 60,000, provided there are no initial charges. For your information, one lump sum means the investor invests all the money for the first year. As you can see in this table, the investor invests all the money, that is 60,000 for the first year. There are no other investment in the second year, third year or the fourth year. So to get 60,000 after 4 years, first we need to do is to find the unit acquired for the first year. In order to find the unit acquired, you have to divide the amount invested with the beginning NAV. Then you will get 40,000 unit acquired for the first year. After you find the unit acquired, you need to find the value of the investment after 4 years. So by using the unit acquired that you find before this, you need to multiply it with the ending NAV for the 4 years. Then you will get the value of the investment. If there are no initial charges, is 60,000. But what if there are initial charges of 5%? As in the case of most unit trust funds, the value will be reduced by 3,000 and end up as 57,000 after 4 years. In order to get 3,000, you need to multiply 5% with the amount invested, then you will get 3,000 of initial charges. To find the value after 4 years, first you need to do is to find the unit acquired for the first year. By subtract the amount invested with the initial charges, then divide it with the beginning NAV, you will get 38,000 units acquired. After that, you need to find the value of the investment after 4 years. In order to find the value of the investment after 4 years, you need to multiply unit acquired with the ending NAV. Then you will get the value of the investment if there are an initial charges is 57,000. Next example is about dollar cost averaging, which means constant payment for each period. If we look at this table for Fund A, where in this situation the amount of investment is 50,000, but it will be invested in 4 different years, where the amount invested is 50,000 per year. If there are no initial charges, the unit acquired for the first year is 10,000 units. To get 10,000 units acquired, you have to divide amount invested with the beginning NAV. Then you will get the unit acquired of 10,000 units. Same goes with the second year, third year and the fourth year. Then, if there are no initial charges, the total amount of units acquired after 4 years is 35,000 units. So if we multiply 35,000 units with the ending NAV of 150 cents, we will get the value of the investment is 52,500. Even if there were no initial charges, the investor incurred a loss of 7,500. If there were initial charges of 5% and the amount invested is 15,000 per year, it means that the initial charges is 750 ringgit per year, which means the total amount invested for that year is 50,000 minus 750 ringgit, and the balance is just 40,250 ringgit that will be used for the investment. So the unit acquired for the first year, if there is an initial charges of 5%, is only 9,500 units. So based on our calculation here, the amount 40,250 ringgit divide with the beginning NAV, then you will get the unit acquired for the first year is 9,500. So for the second year, 14,250 ringgit divide with the beginning NAV, that is 2 ringgit, then you will get the unit acquired for the second year is 7,125. Same goes with the third year and the fourth year. So the total amount of unit acquired, if there are initial charges of 5% is 33,250 units. So if you multiply it with the ending NAV for the 4th year, you will get the value of the investment, that is 49,875 ringgit. So as you can compare the value of the investment with the amount invested, that is 60,000, the investor experienced a loss of 10,125 as compared with the one lump sum investment. If there are initial charges of 5%, the investor only loss of 3,000 only. So means that the investor experienced a huge loss for the dollar cost averaging. Okay, now we use the similar situation for Fund B. We calculate the information about the unit acquired. If there is an initial charges of 5% and if there are no initial charges for Fund B. All of this information are similar to the information that we used before. For example, the beginning NAV, the ending NAV, and the percent change for the Fund B is the same from the previous example. Now you can see that the total amount of units acquired if there are an initial charges of 5% is actually very high. Despite of the investment of 60,000, the unit acquired is 47,500 units, and if we time with the ending NAV for the 4th year, which is equivalent to 71,250 ringgit. So in this example, you can see by having an investment of 60,000, you can get the return of 71,250 ringgit after 4 years. After making a constant payment of 15,000 each year for Fund B, you can get this profit from the investment. Therefore, as you can see from this calculation, the Fund B, which is seen to be not profitable in our initial analysis, is now seen to be very good in our further analysis using geometric mean of return. So it shows you that the value of the investment after 4 years is 71,250 ringgit compared to the amount invested that is just 60,000. By using this information, if you calculate the I, which is the rate of return, you will get the I is 6.99%. To get the rate of return of 6.99%, you have to use the financial calculator, go to CMPD, set began, and is 4 years. I is the one you want to solve. The PV is 0. PMT is negative 15,000 because you pay every year 50,000 ringgit. FV is 71,250 ringgit, and PY is 1 and CY is 1. Then you solve for I, you will get the 6.99%. It is actually quite high because normally it is just around 5% if we invest in fixed deposit. But in these cases, 6.99% is actually considered as a good investment. For the unit acquired, if there are no initial charges, the total amount of unit acquired is very high, which is 50,000 units. So if we time with the ending NAV, that is 1.50, you will get the value of the investment is 75,000 ringgit. So So as compared with the amount invested that it invests, the investor will gain a profit of 15,000 ringgit. Therefore, you have to be very careful in your analysis because if you just look at the return using your naked eyes, you might make a bad recommendation or bad decision in your investment. But if you make the further analysis to your fund using geometric or arithmetic method, then you possibly will get different results.
In retirement plan, we must know that investment is most important thing in retirement fund in the future. Next, there are many methods for investment that can be used to get a higher return with lower risk. For example, dollar cost averaging, arithmetic rate of return, and geometric means. And lastly, the choice of choosing the stock and shares are also important. So, note that you have to make a good decision on choosing it based on their characteristics.